Margin call Monday might be coming. How you can be prepared. And if you're new to the markets, maybe you don't even know what it is. It's a common term used by traders, and you might have also heard of Black Monday. And let's get into why and might the markets gap down and force those sellers to trigger margin call, maybe even as soon as this Monday. So let's get into the details. And first, I just want to pull up a blank chart of the S&P 500 and implied volatility. And you can see right here, as the S&P goes lower, volatility goes up. Now, most people who are professional traders aren't trading, let's say, the S&P, right? Why? Because it returns around 6-7% a year, and you can see it really hasn't moved much since dating back to really September, October of last year. What most traders own, and if you look at the VIX, you see we have a controlled VIX going up, hence volatility going up. But what most traders own, most prop traders, hedge fund traders, most people trading the markets are the momentum stocks. So these are stocks like your Nvidias, like your Palantirs, like your Ippolito, stocks that are down some 50%. MSTR is another one, or so, in a short amount of time, a month or so. Most of these stocks in bear markets, basically these were the stocks when either CNBC, the CEO, your darlings of the market, your Nvidias, that basically everyone jammed down your throat to buy at all-time highs or near the 52-week high. So what most people do is, obviously you say buy, Kramer says buy, everyone says buy. They buy the stocks, but they're not buying them in their 401k accounts where they saved up money for 50 years and now they have a couple $100,000 in their name. They're trading their big books. So if you're a hedge fund trader or a prop trader, you're using leverage, you're using margin. Usually most broker platforms, Interactive Broker, Schwab, E-Trade, Fidelity, give you anywhere between 2 to 4x. Some Interactive Brokers will give you more. So therefore, if you have, let's just say, $1 million account, you're trading around a $4 million book, or at minimum a $2 million book. So if you get, let's say, the stock going down, right? Let's say you bought Nvidia, let's just use the example, let's say at 140, and now it's 111 or 110, 111, wherever it is. You're not just taking this decline, you're taking that decline times 2 or times 4. So let's just do another example. We'll do some easy math stocks out there. So let's just do this Palantir. Let's say you're a hedge fund trader, a prop trader, or even a retail investor. You bought Palantir at 100, thinking you're a genius. It goes to 125. You're popping champagne and roses. Everything's good. And now it's $80 a share. You're down 20%, right? Well, not if you're on margin. You're down 40%. 40% on that position. So what happens is your broker will say, hey, we noticed you're on margin, lots of margin. You're down on your position. You went from a big green winner, you're up, 25, so 50% on margin. Now you're down 40%. We're going to have you deposit more money in your account to cover that margin. Well, if you're a trader, especially a retail trader, maybe you're trading on Robinhood or something, I don't have any more money. My stocks, my money's tied up in crypto frauds like, the Bitcoins and Maras, and I can't sell that, or I won't have enough time to sell that and put the money back into my account. So what happens is, as those traders scramble, they start to sell everything they can, and these are usually the high risky stocks, the stocks like AI, the stocks like Big Bear, which I sold at $10 a share, by the way, from 3.5. Now we're back down to $3. These names are down. They're down a ton, 50, 60, 70%. They don't have time to put the money back into their broker account. So what happens is the broker, usually come Monday morning, will say, hey, I didn't get the money in time. I am selling your position at the open. And that's why if you look, let's just say at an intraday chart here, and let's just pull up a volume chart, and we'll use, let's use the master indicator for this, make it easy so everyone can look at here. That's why you get these flushes, these quick down moves to the downside. Now, usually they happen in the first 5 minutes of the day. And the reason, if we, let's just pull out after hours here so we don't see these pink bars here. Let's just do, we don't want to look at extended hours. Let's just look, there we go, at the market open. That's why you get these big sell programs right at the open. What the brokers do is they force selling. For example, let's pull up NVIDIA. And you can see when NVIDIA has had these big drops here, volume has accelerated, especially as it takes out a prior low, because those sell stops get triggered. The broker will go and say, hey, I need my money right at the open. I am selling those positions at the market, at whatever price. So they're not selling mid-market, or they're not trying to get the best price for you. They're selling as soon as the market opens, causing a flush down. That rolls over to the indexes, like the NASDAQ, like the S&P, like the Russell and the Dow, and that will create a limit down at the open, or in the futures market sometimes. And what happens is, as we limit down, volatility starts exploding. And you can see, look at volume, right? All in here. We had no volume at all in the whole market. And then recently, look, even as we were going up, no volume at all. Then recently, as we started to sell off, look what happens to volume. It accelerates. The reason is that selling is not just, oh, I don't like the stock, let me get out. It's force selling. So that snowball effect is happening. And when you get that boom, big event, usually on Mondays, that drives selling to the extreme, that is force selling, you get volume spiking and you get the stock market flushing lower. Today looks like what we call bull trap, where you have buyers come in, but markets do not bottom on Friday. Why? It's not that easy. The max pain is waiting for all those weak hands to get out. So all the buyers coming in today as the market's up a little bit, as you can see the NASDAQ, those buyers are thinking, hey, this is it. This is the bottom. This is safe. Well, it's not. Markets never bottom on Friday. And one thing to make a note of as well is if you look at the VIX, you can tell we are slowly going up. It's not just a VIX spike, right, like we've had in the past. It's controlled going up. If you look at the S&P 500, every time we've had a VIX spike, what happened? We had a V bounce. We had a V bounce. This time, selling has lasted. We're going to probably have one of these. A U. Let me do it so it's on camera. A U. And then a bounce. And then what we call a H sell pattern lower. So not to be all doomsday, doom and gloom, but it's coming. There's no way around it. Markets are not this easy, right? We're not just going to go up and say, hey, this is all champagne and roses and this is the bottom of the stock market. I wish it was, but it's not. The market will always go to max pain. We have to shuffle out those weak hands, those crypto frauds, those AI scams, all that crap that you probably have been shoved down your throat over the past couple of years. Once all that dumb money gets out, then the market can start rallying. And when it does, you'll have one of these. A rally, like a U, people will get FOMO and start buying. And then as all that money comes back in the market from the FOMO, it pulls one of these, an H sell, and goes right back down again. So we could maybe make the case, we've experienced it a little bit here, where you had the market go down, you had the flush, you had the rally, and then the flush again. I mean, you could maybe make that case, V and then flush. But I personally think here we are bouncing at the 200 day. You're going to have buyers step in. If it's not this Monday, it will probably be next. And then we get that margin call Monday. So what you can do is have some buying power ready. That's what I've been doing. I've been taking positions and scaling in, about 4 positions, scaling in on every dip until I build a big position. Or what you can do is trade, day trade, like I've been doing, selling market maker moves on the XSP, which is the mini SPX, which has been working out very good on the 0 DTE. But whatever you don't want to do is trade naked options. You don't want to do diagonals or calendars, anything that involves having a short naked option. One thing you definitely want to avoid right now, don't try to get over leverage. Again, don't really trade on a margin unless you're very skilled and a professional. Besides that, hey, this is the most opportunistic stock market that we're probably going to have in quite some time, and fantastic if you could sort through the ups and downs as we're going through right now.